Excuse-moi. Episode number 19. Is it 19 or 18? Alright, welcome back to episode number 19 of our Nuggets on the Go. Very happy to have you guys back with us, and happy 2022, by the way. We're right now in, I think, the month of February by the time this is being aired, and we're going to talk about MOAT analysis even further. So our previous episode, we talked about one of the key parameters and key inherent factors in our PLB MOAT analysis whenever we analyze what condominium projects or what kind of apartment projects to enter into when we're helping our clients to decipher through all the many different types of projects in Singapore. When we talk about real estate, there are also three very important things to understand which stage you are in right now. So before I dive further into point number 2, let's talk about these 3 points. So your 3 points will be understanding why do you want to invest in real estate. So we always have this triangle to illustrate our thought process. So what is this triangle? So basically when you look at this triangle, is to understand which stage are you at. So this is what we call our PLB core model. Understanding why do you want to invest in real estate is extremely part of your investment journey, and especially when you are heading out to invest in your first property in Singapore, or you're planning to either exit from your current property or diversifying your portfolio or multiplying your portfolio investments. And understanding why will strengthen your belief as well as helping you to articulate in your mind on what are core fundamental reasons on why real estate is a good investment for your own portfolio sake. So we explored in one of the previous episodes. That episode is talking about real estate inflation generally in Singapore and whether does it apply to Singapore real estate. And in that episode, at the beginning part, we talk about the 8 inherent factors of real estate as a form of asset class, and why are these inherent characteristics of real estate a very unique form of characteristics right here in Singapore and of course globally as well. So this triangle basically is a very important framework that we use in PLB to understand why do we want to invest in real estate, when should we enter the market, should we time the market, should we not time the market, and what kind of properties to select. And that is where our MOAT analysis comes in. Of course, there's one more core factor, is that from number 1 going to number 2 and number 3, the fourth one is about how do we plan our portfolio strategy, how do we plan our structure in terms of investing in real estate. And before we dive into the how, let's talk about the why first, coming back to today's episode. So last week, we talked about one of the core fundamental reasons, and that's MOAT analysis point number 1, is to know that in Singapore, the way that our valuation system works a little bit differently, because our valuation system for condominiums and apartments, when it comes to projects and it comes to year-on-year appreciation, and that usually happens when you want to sell a property or when you want to buy a property, you call up your banker, you ask for the desktop bank valuation, and either you get a shock of your life or you feel very happy, or either you get a shock of your life if your valuation did not appreciate over the past 5 or 8 years, or the valuation depreciates, or you get very happy to hear that your valuation suddenly doubled or maybe increased by about 40 or 50% over the past few years. So MOAT analysis number 1 in our previous episode, if you have not watched it, you can head back to watch it. We talk about the fact that our valuation is vastly and deeply affected by the amount of volume of transactions that happens in the project, and thus the density of the project is of one very important characteristics and factor, and the profile of the current owners that are living in the project is also another very important factor, which then brings us to one very important point as well. Let me show you this project right here. So just imagine if you own this project. This project is a 99-year development. Currently is about 18 years old. And the graph looks like this. So ever since the launch date in 2004 towards its TOP in 2007, it has been increasing. Even in the year 2022, even though right now it's about 18 years old, 99 years leasehold, is still appreciating very gradually year on year, having a very nice momentum in terms of appreciation. Of course, for the first time owners, that would be fantastic because they are sitting on a capital gain of close to maybe about 100% capital gain already. A lot of them bought at $500 over dollars per square foot or $600 over dollars per square foot. By the time TOP, it appreciated to about $700 odd dollars per square foot. Of course, those were the heydays. You cannot go back to that kind of PSF anymore because HDB apartments is already surpassing this PSF level. And right now it's about 1,300 $1,400 per square foot averagely. Will this project continue to appreciate? That's the key question we want to understand. I mean, it has been going up in this direction, so will it continue to go up in this direction? When we look at this other project, this is a freehold development. It's in the prime area, District 9. That project that I just showed you with an uptrend graph, that's in District 19. All right, and that project has maybe about 600 over units, okay? And then this project has less than 100 units, okay? But of course, I'm not talking about big projects and small projects right now. We're referring to the trend graph. 2017, they launched. Look at the graph. It's a downward trend for the past 14 years. So the trend is like this, it's going down. Will this project be able to turn around, or will it continue to go down, or will it go down and stay stagnant? What do you think? This is a question that we need to answer. We need to be able to decipher. We need to understand, why has this happened? What is happening to these two projects? Why is it that one is going up since its launch day 2004, 2007, defied the odds of Lehman Brothers, defied the odds of ABSD in 2013, TDSR in 2013, continue to go upwards until today? And why is it that this project launched in 2007, Lehman Brothers continued to go down, 2013 continued to go down, 2018 continued to go down, until today it is much lower than where it used to be. So it launched at $3,000 per square foot, now it's about $2,000. Dropped by $1,000. Why did this happen? And that is a very real question, because we need to understand it's not about whether does new launch or resale see appreciation. So when people tell you that when you buy new launch, you confirm will see appreciation, that's not true. You and I know that, because there are a lot of new launches that don't see appreciation. There are also a lot of new launches that see a lot of appreciation. There are also resale properties that the moment you enter, for the next 5 to 10 years, you don't see appreciation. There are also resale properties, the moment you enter, in 3-5 years time, you see a lot of movement and appreciation. So why is that so? Now, there are so many different factors, but one key important factor was touched on in the previous episode. Just a quick recap with these two new graphs right now in episode 19 now. The psychology of the price graph going up and down has something also to do with the profile and the margin that the current owners are sitting on. Let me give you an illustration. For example, you bought cryptocurrency maybe just 6 months ago. You happen to maybe purchase Bitcoin while it was like $62,000. Today, at the point of filming, right now Bitcoin is at $38,000. We're talking about USD, all right? And if you happen to be the person that entered at 62,000, now it's 38,000, will you sell your Bitcoin? If you have no need for your investment fund that is parked in Bitcoin as a form of mid to long-term strategy, there's no need for you to sell your Bitcoin, because the moment you sell, you will realize an immediate loss. It will be an immediate red color mark on your balance sheet. What will you do as a mindset of an investor? Maybe you will think that, hey, it's okay. That's my investment fund. It's an additional fund that I set aside. It's not for my daily need. I've set aside that diversification to go into Bitcoin as a form of investment. I want to hold it for at least 3, 5, 8 years time. I have no need to sell right now. And maybe you tell yourself, I will hold it minimum 3 years. Why is it that I use this illustration of 3 years? Is because when we come back to real estate, residential real estate, the moment you buy anything, there's a blackout period of 3 years. For 3 years, you will not sell, because if you sell within 3 years, you will be hit by the seller stamp duty of 12%, 8%, and 4%. So everybody enter with the mindset to hold it for at least 3 years, so we don't have to pay unnecessary seller stamp duty, right? So you'll buy it, you'll sleep on it, you will use the property, you will rent it out, you will live in it, you will not sell it within 3 years. So that's your own personal blackout period. Similarly, if you enter Bitcoin 62,000, now it's 38,000, your mindset is that I will not sell. I will hold it, I will wait for it to recover. However, if you belong to the other category of investors, for example, you bought Bitcoin at 24,000. Right now, it is 38,000. You might be thinking that, hey, I've seen a gain of 14,000. If I want to sell because I identify a better investment, okay, I think I will sell because I'm sitting on green. I'm making a profit. I'm making a paper gain. And the moment I sell, I realize the gain. I can then use my profit plus my original capital. I can invest in another asset that I think has a higher or faster growth potential. So your mindset is very different when you're sitting on paper loss and if you're sitting on paper gain. The same ideology happens when it comes to real estate. And I'm not saying that it happens for everybody, but I say generally speaking, it happens for existing owners. So for example, if you belong to the first group that I show you the graph of an uptrend for the past 18 years, if you happen to be the first, second, or third owner that enter progressively, you're sitting on gain. There's no need for you to sell if you have not seen anything that is better than your current property, or maybe you're so comfortable here, you're just thinking that, I'm sitting on a paper gain. If I want to sell, okay, I want to sell at the current price, or I want to sell higher than what my neighbor just exited last month. It will then become a psychology that you have that you're not urgent to sell because you're already sitting on paper gain. And if you want to sell at a slightly higher price that your neighbors have exited maybe 3 or 6 months ago. So that's your psychology. If you're sitting on a paper loss, you will only sell when you really need to sell. That means you really need the money. You will only sell if you are really at a stage that you felt that there's no chance that your project can recover because the valuation is damaged through the past 10 years of a declining transaction PSF level that has brought down the PSF. And if you notice the graph, the amount of transactions usually in a downward trend is very little. Why? Because a lot of owners are demotivated to sell. The moment they sell, they realize their net loss. And thus, they hold on to their property for a longer period of time to wait for recovery. But sometimes, at a certain point in time, certain owners will think that I don't want to wait anymore. I've seen this other property that my family love. It's a bigger one. I can afford that. I think I'll just cut my paper loss. I'll just exit at whatever bank valuation is right now, even though I lost $500 per square foot. I'll just cut my loss, move on to my new place. Or maybe they could be foreign investors or foreign buyers that is in a very different position if you are Singaporean, because foreign investors think differently. Why is it that they think differently? Not only do they think differently, they have something that works very separately from Singaporean investors. Foreign investors, if they come from their native country whose currency is performing weaker than Singapore currency on a year-to-year basis, even though if they were to sell at a net loss, when they translate back Singapore's currency, what they get back from the net loss property back into their native currency, they might still see a gain. Which is why you see certain articles about some foreign investors in the past few years who sold their property at a loss, but when they translate back to their native currency, they still see a gain. Because our Singapore currency has appreciated so much against their original country's currency by so much over the past 5 to 10 years. So that is something that is working for foreign investors. That is of course an additional benefit, and that's also an additional reason why foreign buyers love to purchase Singapore property, because not just you're buying a property on Landscape Singapore, you're buying a property in a base currency that's appreciating against their native currency. So coming back to this two graph, this characteristics that we are talking about is that if the original profile of the current owners that are holding on to the property is not sitting on a paper gain, most of the time they're demotivated to sell, which then translate into a lower level of transactions. But that also means that the second effect will kick in easier, which brings me back to this. If the valuation of the project is damaged because there was a fire sale, if some of the owners who were already sitting on paper lost through the years, they just want to maybe just exit and switch to another property that they think has a higher potential to appreciate, they are not going to wait anymore, the project will find it very hard to recover. I believe that you will reach a saturation point that it might stagnate or it might recover, and that point will come when all surrounding projects are so much more expensive in terms of PSF compared to these projects. But if the surrounding has not outperformed this project by huge disparity, then it might continue to trend downwards a little bit more, or it might just stay flat before it really hit the recovery point. But sometimes the recovery point may come after 10 years or 15 years. So it's very hard to say because for every project, it performs very differently. So this is a little bit like a contrary kind of thing, because a lot of people think that, you know, I need to buy properties that has not seen that uprise, right? But the contrary effect is that this uptrend actually motivates the current owners to price their property slightly higher and challenge the next asking price. And when the asking price is being challenged successfully, somebody transacted it, then it will increase the entire valuation of the project gradually upwards. And that's how the uptrend curve happens. And usually when uptrend curves happens, the current owners are holding on strong, they're not letting go, their property's cheap, then it brings out the entire project gradually over the next 5, 10, 15 years. So usually that's what happens. But of course, we're not talking about other things like Ballas curve and all this kind of stuff, right? So this is really about the uptrend or the downtrend. Now, coming back to our next point in the MOAT analysis. So as you all know, MOAT analysis, we have various different points. We also have our MOAT analysis on our PLB channel, just to show a little bit how it looks like. So if you happen to meet any of our listing managers and listing specialist consultant or our buyer consultant, what our guys can do is that we are all trained in MOAT analysis, because this is our core fundamental tool that we help our customers to identify and sift through all the projects based on the districts and estate that they love. We sift through with our a point system to grade the projects. The projects grading will change through time because sometimes there are new things that popped up. There are new transactions that happen, and this is a live update. So basically, this is our PLB condominium MOAT analysis. As you can see, there are about 5, 6, 7, 8, 9, 10, there are 11 points. Okay, volume effect is the point number one that we just talked about. There's density effect as well, developers experience, or district kinetic effect and things like that. And of course, parents attraction factor is so important. Why is parents attraction factor important? Is because parents attraction factor basically affects the buyer's audience. So always remember, when you want to invest in a property, the most important thing is to try to visualize in 3 or 5 years time or 8 years time when you want to exit, how wide or how big is your buyer's audience that might like your property, because that's the one of the most important point, and that can only be determined through various scoring system and various factors that really adhere to the amount of audience that might be present in 3, 5, 8 years time. That's how we use MOAT analysis to our clients' advantage, and that's how we select properties for them. Most of the time, I always share with my customers that if you're hunting for your first property, the most important thing is to note that you need to balance out your family's preference and needs vis-a-vis having that investment engine within that property. So try to find a balance. I will usually recommend having 50% coverage in terms of family preferences. That means, for example, if it's for me, what my kids would need in terms of the amount of bedrooms, do they need facilities, do they need pool and things like that? Do I need a gym? Does my wife work out? Do we prefer basement parking? Do we prefer multi-level parking? And how near do we want to live near the MRT? Do we want the kids to be independent, to be able to come back from school by themselves and things like that? And also things like, do we want to live near a shopping mall? Do we want to live near our parents? Do we want to live near our siblings? So try to find that 50% factoring factors to be for the needs of your family, because always remember, if your family is happy, every day will be happy in your home, because your home is there to serve your family. Don't reverse it. Don't serve your property, because don't be a slave to your property. Let your property serve your family. Let it be a place to build good memories with your family and kids through their growing up years and things like that. And let your spouse be happy together with you as well. The other 50%, try as much as you can to have inherent factors. From our MOAT analysis is one range of factors. If you have your own investment philosophy, you can add those in as well. The other 50%, try to have that investment inherent factors engine within the selection criteria, so that you know that in 5, 8, 10 years time, when you want to exit, there's a wide array of audience that's willing to buy a property. There's a better chance to see upward appreciation through the years. So at least when you're living there for the next 10 years, your property is working for you in terms of building up that capital appreciation. Because sometimes it's a little bit sad to know that, I bought my property in 2032, and I want to move to a bigger property. I bought this at 2 million. If 2032 is still 2 million, I will be very sad, because I always share with my customer, if your property do not appreciate, the risk is very high. You want to purchase a property with an upward momentum. It can be gradual, but at least it must be able to fight inflation, because if inflation is 2.8% or 3%, 10 years time it must appreciate by at least 30%, because it must fight inflation. If not, your dollar just keep getting smaller and smaller. The amount of principal that you pay down on your loan just gets smaller and smaller. Not only do you have to fight inflation, you also have to pay back the bank's interest, 1.3, 1.5 or 2%. So these are things that you need to factor in. That's why it's important to find a product that has a higher chance of appreciation. Of course, nobody has a crystal ball, but we believe that we have deciphered a certain level of amount of code to find out which projects has a higher propensity to appreciate in future. So point number 2 that we just shared with you regarding our MOAT analysis was to identify whether the project that you're intending to go in, whether does it have an upward trend, or does it have a downward trend, or does it have a stagnant trend, and try to decipher what it has went throughout the past 5, 10 or 15 years. Because if you have followed us closely on our series, there were a few key moments that happened. Number 1 was during the 2013 TDSR period. That was actually one of the most decisive factor that affected a lot of per square foot plus quantum play effect that came in. We also talked about that in our previous 2 to 3 episodes as well. You can catch that. And coming back to another point that we want to share with you, other than the upward or downward trend, is to note that Singapore is vastly different. So sometimes we might be a little bit fearful to enter into the private property market, because we were thinking about, what the property market crash, like 16 December, there was another round of cooling measures. Now ABSD has increased, and then, foreigners might not come in to buy residential properties anymore, because now it's like 30% ABSD just increased by 10% overnight. TDSR dropped to 55%. However, it will be beneficial to understand how Singapore real estate works, in the sense that Singapore has technically built its own moat. So Singapore is vastly different in the sense that it has close to about 1.2 million HDB apartments, and that's why Singapore has one of the highest home ownership rate in Singapore. Our local government is so smart because they have planned this since our early founders days. This has built such a great foundation in Singapore, and that's one of the core reasons why it allows a lot of people to propel upwards towards the mass market condominiums. And when families mature into their profession, husband and wife work harder, they build their businesses, build their careers, they then move on from mass market condo to landed properties or condominiums in the central region and things like that, or they buy additional second or third properties. And if we study how our base support level work in the residential market, technically speaking, the base support level comes from this level that we are showing you. Technically speaking, how do our government pump money in the real estate market is through subsidized new flats, through our BTO system, and through our resale grants. Of course, our government's intention is very good in the sense that it's to support marriages, is to support new families to build their families early, is to support young couples to buy their first home earlier rather than having to rent. Because technically speaking, if you look at the amount of resale grants that HDB is giving in terms of CPF housing grant, it can go up to 160,000. Averagely, of course, if you have a median income as a fresh grad, you might qualify with near parent scheme, maybe up about 80 or 100,000. This grant is extremely important because with this grant, you technically don't need a full set of down payment in your CPF account to funnel into your first resale property, and you can get your first resale property immediately, provided, of course, there's not a lot of COV involved in the resale flat, which is what's happening on the ground right now. Secondly, if you're able to wait balloting process, wait another 3 to 5 years, then you can go for BTOs, which are also highly subsidized as well. And most of the time, after 5 years, once you completed your minimum occupation period, BTO definitely, highly likely, always see an upward appreciation in terms of the entry price towards the exit price when they hit their 5 years MOP status. We have seen it throughout so many years. Resale property, we always mention if you buy a property at 600,000, you get a grant of 100k. Even if you sell after 5 years at 600,000, technically the 100k is still yours to keep. You don't have to return it as long as you do not touch another brand new BTO, you don't touch another sales or balance flat, you don't touch the EC. You can keep that resale grant throughout your entire life if you move on continuously towards resale HDB properties or private properties. So this forms the base support level for our overall residential market structure, because this creates an early entry point into the residential market through HDB apartments. Once the young families, they are in their mid-30s or late 30s, and once they have built their career after 5 years or MOP period, they built capital through the 5 years by paying down their installments, paying down their principal as well. When they sell, they can then use this capital that is currently trapped in their HDB apartments and unlock it and then repurpose that into their next private property. And most of the time, they will then upgrade to mass market condos, or they might sell their HDB apartments, buy a mass market condo, invest in maybe a smaller condo in RCR or CCR region. So that is usually the trend, and which is why this support level will then funnel into the OCR market. You will then funnel into RCR and CCR market, or it might then go up to the landed market. So this is a beautiful concept. On the surface level, it seems invisible, but if you do deep dive in, you will then see that Singapore has this very beautiful inherent moat that's plugged into our entire residential market. So if you are talking about whether will our price crash, it will not crash. I'm very confident to say that it will not crash because we have a strong base level of home ownership in Singapore. We are mainly homeowners in Singapore, and there's no need for a lot of people to sell their HDB homes unless they're upgrading or they're shifting locations. They can hold on to their properties, and with HDB as the base level, condominiums, a lot of people are buying for own stay, and with such strong cooling measures plug in all the way, 25% down payment, TDSR, additional buyer stamp duty, home ownership being 90%. I think Singapore is really in such a different phase right now. In fact, this phase has started way back in the past 10 years, and you will only see very, very gradual upward appreciation throughout the next 5, 10, 15, 20, 30 years. And most importantly, if you're a Singaporean, I think it's very important to note that the key fundamental differences between a HDB apartment and a private property apartment, because when we talk about 8 inherent characteristics, of course, we are not advocating that, you should definitely sell a certain type of property. But what we're saying is that if you have the fundamental ability to take a deep dive into understanding your investment horizon. Your investment horizon is technically quite short for everybody, because from the time you start work, 20 plus, 30, 35, up to 65, that will be where your investment horizon for a property is. It takes a lot of things to clap. You must have proof of income. You must have tenure to loan. You must be able to sustain your monthly mortgage through the years of investment as well. This 8 inherent characteristics, there's one very key important thing is that the type of asset that you're holding, if let's say you're holding onto a HDB apartment vis-a-vis a private property, is that the one fundamental difference is that for a HDB apartment, no matter how much paper gain that your property make, let's say you buy a BTO for 450,000 and now is worth 750,000 after 5 years of MOP, that equity is trapped. It's basically a paper gain that cannot be withdrawn. That equity is trapped. It's unlike private property. Private property, if your property appreciates, you technically do not have to kill the golden goose. You can extract equity through an equity term loan. You can extract it out. You can then use it for different reasons. You don't have to kill the golden goose if you still love that property. For HDB apartment, it's different. There's no equity withdrawal option. Your equity is being trapped in the property, and that will of course hit an inception point, because there will definitely be a year that you suddenly see your HDB value starting to dip. Of course, we're not talking about the fact that if it's in the seller's market, everything just goes up like what has happened in the past 2 years and even right now. And the key fundamental reason why now HDB apartments are continuing to rise up gradually is because private property has went up so much that HDB apartment will have no choice but to go up gradually. We also talked about that in the last episode. So when people cannot afford that increase due to the fast upward rise in private property prices, they will then have to fall back on HDB apartments, which will then cause an upward trend in HDB apartments as well. So, but of course, in a stabilized market, you will find an inception point where suddenly in this phase in time for your HDB apartment that you will see the value starting to dip gradually, going into a downward curve, especially also when you have a lot more new apartments coming out in your estate. There are more and more BTOs, more and more beautiful brand new apartments that's popping up year after year, and they hit their MOP period. They will always be the cream of the crop because everybody loves new things. Everybody loves to buy that brand new 5 years to 10 years old new HDB apartment that just hit the market with after fulfilling the MOP period. So something to note, if you do have the ability, do plan forward, because most importantly is that if you're still young, you're still building your career, you have the financial capability, you have done your financial prudency, you have sit down and work out your finances, that you are able to hold a private property for the next 5, 10, 15 years, then I think you should really make that decision to really sit down with your spouse, discuss with a professional consultant, and try to plan out a roadmap for the next 10, 20, 30 years. I think we've come to the end of today's episode number 19. Of course, we hope that this episode will help you to understand a little bit more about our MOAT analysis as well as some of the key inherent characteristics of real estate in Singapore. And we hope to see you soon on episode number 20. My name is Melvin Lim. Thank you for staying tuned with us on Nuggets on the Go. Meantime, take care and we'll see you soon. Cheers. Point number 2 was to understand, point number 2 that we just shared with you. Okay, so point number 2. Sorry, let's not talk about point number 2. Okay.